Welcome back to another episode of Bitcoin Biscuits, where today I'm going to be talking to you about buying uranium over stocks. And as I discussed in my previous video, also over Bitcoin, because Bitcoin is currently in a bear market. And to be honest with you, I got this idea from watching Benjamin Cowen's video when he was discussing the S&P divided by gold, and how whenever it breaks down from a certain level, you see gold outperforming stocks in general. This is the S&P, so it's just the general basket of the top 500 companies in America. Gold will outperform most of everything, and you're better off in gold than you are in stocks. And I wanted to compare that to uranium and basically apply the same thesis to uranium, and I'm going to show you what the result of that is in today's video. So jumping in, first up, what we've got here is, so this is the S&P divided by gold. We're on the monthly chart, so each one of these candles that you see right here is a month, so it's over the long time frame. And we've got that key level where around the 1.4 level, where it is currently in the process of breaking down. Well, it looks like it's going to. It might not. It might bounce here, have a relief bounce, but it looks like it's heading in the direction of it's probably going to be breaking down. Now, what historically has happened when the S&P, so think about this is the S&P divided by gold. So when the trend is up, you want to be in the S&P. So for example, from here, from like 2013 up to, call it what, 2022, you wanted to be in the S&P. And sort of from 2022 to now, and probably going forward, you wanted to be in gold, because gold has outperformed. Now, if you can even do a measured move of that just to see. So from the top in 2022, the S&P against gold is currently down about 48%. Call it 50%. So you would have made 50% more by just holding gold than holding the S&P since 2022. So if we just look back in history, and you'll see I've drawn some lines on here, which is basically every time it's broken down from this 1.4 level, you'll see, now this is where I want to compare it to gold and the S&P individually. So if we just zoom out here, what you'll see is I've got a blue line and I've got a green line. Now on the blue line is the S&P, and the green line here is gold. And what you'll see is that I've drawn some yellow lines. Let me just make this a little bit bigger. Where the yellow arrows are that I've drawn on here, you can see that, so the blue one, on the line where it's broken down, so that turquoise line that's going vertically through all of the charts, that's where it breaks down that key level that I was talking about. And you can see when that happens, the S&P drops, has a big drop, and gold goes up, has a big move to the top. So if we just zoom in here on this first one, and I click on the S&P, like how big was that drop when it broke down? Oh, 1 second. So right here, this is the first one, and here is that drop. So the measured move from the top, which is when it broke down, to the bottom is about 46%, 47%. So you can call it a 50% drop in the S&P. Now, what happened at the same time for gold when it broke down? Well, you can see that gold went up. And gold initially went up about 191%. Now, I'm not saying gold is going to do that right now. Gold is currently at all-time highs, and it is possible that gold will have a correction at some point. But the point of this is that when gold has a correction, it will probably correct. It will drop less than the S&P, and then it will probably go up and continue its rally after it has that initial correction. So as you can sort of see here, what happened was, so if I just get rid of that, on the green line you can see that gold went up initially and then it had like a big drop. So if I just get the pen to show you, I just grab the brush, so you can see that gold went up and then it went down, yeah, and the S&P went down and then it went up and then it sort of just went flat a bit. Now bear in mind this is all the way back in 1972, so this is the first one back in 1972. So yeah, so when gold went up and then down, gold did drop while the S&P was going up. So I don't know if I can make this much clearer, but you can see on here where gold went up and then it went down, the S&P went down and then the S&P went up. Now here's the thing, although the S&P went up when gold went down, gold did go on that second bounce. Gold continued to go and put in new all-time highs, and so did the S&P. As you can see, it went on. So what I'm saying is to look out for that correction in gold, because when gold has its correction, it's probably a buying opportunity for gold, but it's probably also a buying opportunity for risk assets, including Bitcoin. So anyway, so that's the first time that happened. Now if we have a look over here, on the right, you can see the same thing happened again. I'm not going to go into it as much detail, but you can see when it broke down from that 1.4 level, the S&P divided by gold, so this top chart up here, when that broke down, the S&P got another big correction and gold went up and to the right, right? So you can see here what initially happened was that gold did dip. It had an initial dip, and if you want to see from the actual level, it dipped about 17%, 18%. Now you can compare that with the S&P, which dropped around about, from here to there, it dropped about 36%. So there's a massive difference, right? This is what I'm saying. So when the S&P divided by gold drops down below that 1.4 level, the S&P and gold are probably both going to drop, but gold's going to drop less than the S&P, and then gold is going to go on and put in new all-time highs. Okay, so as you can see, in these charts that I'm illustrating here, and here we are, like right now. Yeah, this is where we're currently at with these charts. The S&P is sort of tapering off, sort of flatlining a little bit. I mean, yeah, it's at all-time highs, but we are currently in the process of breaking down from this 1.4 level. So this is something we need to watch out for. But I was really interested to see what happens when this breaks down, when gold breaks down, or if gold breaks down against, if the S&P breaks down against uranium, to see whether or not uranium is a better investment than the S&P 500. So I've got that chart here, and I thought this was quite interesting actually. So if I just look at the actual uranium chart, so this is uranium ETF, so URA divided by the S&P 500, and you can see if I just put it down to the weekly chart, if it loads, here we go, right, and then I've just put on the loss line, which I was telling you about the other day. It's flipped gold, and it's going up, right? It's going up and to the right ever since, like, it had like a double bottom so there's 2020, and then the second bottom was at the end of 2020, and it's been going up sort of since then. But it's more of a consolidation range, and it's kind of in the breakout like right now. So yeah, so that's it really. I mean, again, if we go to the monthly, you can see it's looking like it's only just starting to break out against the S&P, uranium against S&P. So that is where I'm making my bet. I've bought already into uranium, various uranium stocks, including URA ETF, and we shall sort of see how that plays out. But I think it's gonna do well. So you can sort of see here. So the interesting thing is that all of these charts are pointing up and to the right, and the uranium one is also starting to point up and to the right, the same as S&P and gold. So that's it. That's really all I wanted to say. I thought it was quite interesting to sort of see how it looks like we're catching this trend early with uranium over the S&P. And hopefully that will be a good investment for the next few years. So yeah, I don't know. Hopefully that made sense. If it didn't, please drop a comment down below to let me know, and maybe I can make another video to explain it in a little bit more detail. But other than that, thanks for watching, and I shall catch you guys in the next video. Bye for now.